Have you ever wondered, what does equity really mean and how does it really impact my wealth from my business? This episode is just for you. Today, we're breaking down three things: what equity is and why it matters, owner's equity and distributions, okay, and how equity impacts the value of your business. Stay tuned. Hello, hello, hello. I feel like I really like this. If you're watching on YouTube, I really like this. That's cute for me. It's like it's giving rich. So I'm like, okay, let me talk about equity in this striped shirt with the long sleeves. And she's like, eh. So I am your host, Iyanna Vaughn. Welcome to another episode of Harmonious Wealth. I'm going to talk about all things equity. So for the past few episodes, we talked about your girl, your girl, your girl, your girl, the balance sheet. She's going to tell you like it is. She is your real friend in business because if your balance sheet is correct, then your entire financial systems are accurate in your business. And, it equity really defines like your long-term health. So equity as a formula is your assets minus liabilities. We know that your assets come from like your cash on hand, and it comes from like your accounts receivable and how fast you're able to kind of make that accounts receivable turn into cash on hand. It also includes like your liability. We talked about in the last episode, liability can be like your credit card debt, line of credit, all those different things. And your equity is what's left over, and within equity, we have like your profit as well as your distributions and things of that nature. So, when I've been working with a startup company for the past few months, and it's really interesting because we go over like a potential seller's financial reports and we look at their like years worth of their profit and loss statement, years worth of their balance sheet, and it really shows like over time how like when you start a business, a lot of times we don't think about selling, and being in the position to look at financials of people who are wanting to sell their business and really conceptualizing like what their life's work is quote worth on a financial report is really has been really interesting. And, when we look at the valuation of a company through the different aspects of their business, I won't touch into valuations in this episode, but as like a summary, we can do like different multipliers. And typically, when it comes to looking at like your future discount cash flow rate, that can be one that is utilized that we're utilizing. And we also like to look at your equity, what's left over, and we're comparing assets versus liabilities to see like, okay, what does it take or what would be our like final purchase price for this entity. And today I want to talk to you about just overall what is equity. So take a listen. Okay, so equity, right, is the formula of what is left over after your assets and liabilities. So again, it equals your assets minus liabilities equals equity. And your equity shows the true financial worth of your business after subtracting what you owe from what you own, right? And it's important because it really tells us how strong your business is and how much like profit you're retaining in your business just holistically. It shows everything ideally. And when you look at your balance sheet, I'm not sure if you have it up. If you have it up right now, if you're watching me on TV or if you're listening to me in your headphones, take some time today, rewind it if you have to go back. And I want you to look at your balance sheet because your balance sheet inside of your equity is going to show a few things. It's going to show your retained earnings, and that's what you have retained in your business year over year. That only changes once a year. And if your retained earnings is changing every month, something is vitally wrong. And your equity is also going to show your net income. So your net income, we know, is like your profit. Your revenue minus expenses equals your profit. And then what is also in your equity is going to be your owner's equity, which is typically your distributions. And just to kind of tie that in all together, if your equity is growing, right, your business is building financial stability. We want your business to retain equity in your business at all times. And positive equity means that you're increasing the value of your business. And if your equity is shrinking, that means that you're accumulating a little too much. You might be accumulating too much debt, or you might be, paying yourself too much distribution, and then you don't have much equity left over. And, when we think about equity, we want to think of it as the foundation of your long term financial health. So, really take this seriously. Again, your balance sheet is that girlfriend that's going to show you and tell you what it really is, and really just kind of give you that truth. We're not going to talk about like your attachment style with money or anything in this episode. We're going to, again, focus on this being more objective. Okay. Now that we know what equity is in your business, let's talk about owner's equity and distributions. So, owner equity means, as an owner, what you're taking out of the business outside of like your salary. And if you are a single member LLC, you have the ability to be taxed as a sole proprietor, which means basically whatever is your profit is going to show up on your Schedule C, which will be subject to both income tax and self employment tax. Or if you are a single member LLC and you're taxed as an S Corp, you will be taking a salary of reasonable compensation. We won't get into that today, but you'll be able to be paid in two different ways. First way, which is the most important, will be your salary. And then the second way would be through distributions from your profit. And a lot of times, as S Corps, they do quite the opposite. They take their payment from their distributions and then salary a little bit just to kind of give a little something to the IRS. And it's a pass-through company, so you'll still be taxed on that income. I mean, the net income, which is going to come from your business tax return, and your K-1 is going to flow to your personal tax return. That's just me kind of going over it in general. We will have separate episodes on those things. Don't get in a haywire. We're just discussing owner's equity. So owner's equity, includes what you can distribute. So there is a tax distribution because your business is a flow through entity as an S Corp. Your business can have a tax savings account. And then if the business incurs taxes because of the net income, I would ideally pay that through a tax distribution so that you're not trying to pay for it on the personal side or have tens of thousands of dollars like in tax debt. And then there is that profit distribution, which means like out of profit, as the owner, you're taking out distributions. So the profit distributions or withdrawals are called your owner's draw, right? And say if you're using like QuickBooks, it could be like owner's pay and personal expenses. Those terms, owner's pay and personal expenses, owner's distribution, owner's draw, are all of the same thing. And they are the profit distributions for a company that is taxed as a sole proprietor or taxed as or a partnership. Very, very streamlined and very simple. It does get a little different when you are taxed as a C Corp and your distributions as well as your salary are both taxed. We will not talk about that in detail to this time, but I'm just going to tell you the equity. Owner's equity includes, again, your tax distributions and your profit distributions. So, one thing that we get wrong in business is taking out your profit distributions a little too soon, and it can deplete your cash flow and your equity, making it harder for you to reinvest in your business and grow. So, what that means is, you're paying your distributions as if it's a salary to you, when if you're an S Corp, you should put your full, like what you need to pay yourself as your salary, especially if it aligns with your reasonable compensation, so that we can know if your business can, in fact, pay a full salary to a CEO or someone who's like the lead technician or whatever your title is, because you run the risk of overstating your profit. And then you're just kind of depleting your equity because you're taking it out in distributions, your profit distributions, when it should have been a salary. We want to So if you ever experience like I have positive cash flow or not, I have a positive profit margin and my cash on hand looks different, It could be a few things. We talked about how your liabilities can deplete cash flow, but also this is actually more common. You taking out distributions out of your company is also depleting your cash flow in your business. And it's also decreasing your equity, decreasing your value, your future value in your business. So, speaking of how equity impacts the value of your business, let's talk about what that means overall. So, there are different ways to value a business, and it's also an art, and it's not set in stone. But I can guarantee you the higher equity you have in your business, the higher your value is going to be. No matter what type of valuation figure that someone uses, they will look at your equity and it will impact how you can sell your company. And when you have higher equity, this can potentially help you sell your business. It can attract investors and it can also secure financing for your company, which can play a huge role in the growth or scaling of your company. And, it looks so much more attractive than, you having a bunch of liabilities and it depleting your equity. Again, this is objective, no judgment whatsoever. We're just stating the facts and we're trying to give you the truth, right? When I say we, I mean the balance sheet and me. Me and the balance sheet trying to give you the truth. And, when you increase your equity, it can build long term wealth. So, say, for example, if you are looking to sell your business and you want it to be worth $1 million in the future, and there might be again different variations of how to get to that $1 million valuation. What I can guarantee again is if you maintain healthy equity, which means so you're retaining equity in your business year over year, you have healthy net profit, you're paying off your taxable debt through tax distributions, and then you're retaining your profit. You're not depleting your profit distribution every single year, might be every quarter or whatever have you, right? So then that way your top line for your balance sheet, your cash is growing every year. That's going to help you overall increase your value. So I have some homework for you. If you can look at your balance sheet, okay, talk to your girlfriend balance sheet and pull it up and see where your current equity is. Has it, if you want to look at it quarter over quarter, year over year, month over month, see if that has been increasing in your business. If not, like say if it has been decreasing, like what are some things that are showing up for you? Is it because your net income is going down? Is it because you were kind of paying off some debt and that was decreasing your cash flow? Is it because you were taking some distributions? Like really sit with it and just kind of understand, what's going on with your equity. Okay. This way you can create a plan, a profit plan. Profit plan doesn't only include like your net profit, it really includes like the profitability, like the overall value of your company. And, as we wrap this up, this is a short episode, I want to recap to you that equity shows the true wealth of your company. When we also looked at your owner's equity, which includes like your tax distributions as well as your profit distributions, are you taking that as if it's a salary? And if so, especially if you are an S Corp, how can you recategorize or just restructure your salary to be like, to really replace what you take in distributions, because your profit distributions should just be, you paying your distributions as the owner and, kind of giving you that, this is like extra of what you received because now you are able to execute as CEO and as owner. So you're taking that out as the owner. And then also how equity plays a role in your business value. If you were watching this on YouTube, let me know in the comments below what resonated with you most and like what you're going to look at in your business. I would love to, answer you. And then if you are listening to me on the podcast, I would love first, if you've been listening for a while, rate and subscribe. I look at every single thing. And if you are following us on Instagram, we're at Harmonious Wealth on Instagram. DM me if you like. If you want to, share something private, I'm open. I can definitely help you or make it another episode to kind of answer it anonymously. And one thing that I have is my Harmonious Cash Flow Planner. So, the Harmonious Cash Flow Planner is going to help you alleviate some of those cash flow surprises in your business. And it's going to help you create a prediction for like your revenue, understand your expenses, but then also kind of outline like how does your liabilities or like your distributions play into your cash on hand. That way, months down the line, there's no cash flow surprise for you and you're able to maintain healthy cash flow in your business. If this is of interest to you, go to lovelyfinancials.com/planner to get your beautiful hands on your cash flow. Get on the planner. Okay. If you're a woman growing both your business and your family, and you want to just release all the worry and anxiety about money in your business and your life so that you can build a legacy or help build a legacy for your family, subscribe on either YouTube or listen wherever you catch podcasts. I'm on a mission to help over 100 women reach at least 1 million in net worth so that they can build generational wealth and just kind of cancel out those generational curses, okay? If this aligns with you, I would love for you to be a part of the community of Harmonious Wealth. And until then, I'll see you later. Bye.